My name's Kimberly Grauer. I'm the senior economist at Chainlaysis. And today I'm going to talk to you guys about Ethereum Whales. And we're presenting new research on the Ethereum Whales and their effect on the price of Ether. For those of you who don't know, a whale is just a large holder of the cryptocurrency. Before I start, I just want to give you guys a brief introduction into what Chainlaysis is. We're a software company, and kind of our foundational belief is that transparency builds trust. However, cryptocurrency markets need more trust. And the way we do that is we work with the three major stakeholders within this ecosystem. We work with financial institutions, law enforcement and regulators in cryptocurrency businesses, and we essentially provide them with investigative and compliance software to allow them to achieve that transparency. One of the great features of having that software is that we can also do a lot of market research. And so on the research team today, we decided to focus on what's happening with Ethereum Whales. Because every time there's a major price change or price movement, people are always speculating on what is the cause of that price movement. And one of the inevitable reasons that people pose is that it's a whale, that is a large sell-off from a whale. And those whales are mysterious because we don't know who they are. And they're also much watched. So that's what inspired us to do this. And we focused on Ether because according to our definition of what a whale is, Ethereum whales are holding around 33% of the total circulating supply of Ether. And now that's compared to the same definition applied to Bitcoin. Those whales are holding around 20% of the circulating supply. So, Ethereum whales are actually, there's a lot of power concentrated within their hands, which is why we wanted to study them. So let's dive in. I've got a lot of whale imagery here, so bear with me. What is a whale? Essentially, what you would expect, it's a large owner of cryptocurrency, in this case Ether, who holds their cryptocurrency off of exchanges. A large holder we defined as, we took the top 500 holders of Ether in each year and decided that that's our definition. There's a lot of different ways that you can define whales, and this is the one that we chose to use in this analysis. But you can't just look at those top holders because a lot of them are probably exchanges or services. And to analyze them as though they were a whale would be pretty much misleading. So what we do is we extracted those services from the top holders. And this is the yellow in this graph shows those services. In this case, those are mostly exchanges. In 2019, there was a little over 100 services that we identified. So we had to extract those from our sample if we really just wanted to understand the signal from these whales. One interesting trend, which actually doesn't have to do with our final results, is that you can see services are becoming increasingly more prominent in the Ethereum ecosystem. And that probably signals that either people are getting more comfortable storing large amounts of Ether on these exchanges, or just that that's where new entrants are storing their Ether. When we analyzed these top holders, these whales, the first thing we did was we looked at not only how much of the Ether supply they held, but also how much of the transaction activity, the economic activity, are they responsible for. And what we found was this contradiction. While whales hold a huge amount of the Ether supply, they actually don't account for that much of the economic transaction volume that you see on chain. So in 2019, they were holding, like I said, around 33% of the total circulating supply, but they only accounted for around 7% of the economic activity that was happening on the Ethereum blockchain. That's a contradiction, but it might actually make sense, because when you look at these whales a little bit deeper, for example, we looked at every single whale, and we asked, what can we know about these whales? We have information on how many transactions they're doing, where are they buying their Ether from, where are they sending their Ether to. How many deposits are they doing? When was the first time they transacted and when was the last time they transacted? And from that, we could build out this taxonomy of Ether whale holders. And we classified them into several buckets. Today we're focusing just on the trading whales, but we actually did create a classification for OGs, which are the original investors, individuals who received their funds before July of 2015. The ICO investors are whales or individuals who are investing in ICO contracts, similarly with Ethereum contracts. We have the hodlers who haven't been active within the past year, depending on which year you're taking the sample from. And what we found was that a majority of the whales are actually not active. They're holding. They're not meaningfully engaging with the cryptocurrency ecosystem. So if we go back to this slide, it's actually the whales that are holding all that wealth, and also the fact that they don't account for a comparable amount of economic transaction value, it makes a little bit more sense. This is just to kind of set up who these whales are before we can get into like the number one question, which is, do they affect price? And so just to summarize the past few slides. Services are increasingly large holders of Ether. That was the first slide. And most of the whales are actually not active traders, although they do buy from time to time, but they're not meaningfully engaging with exchanges most of the time. But the active trading whales are holding around 14% of the total circulating supply of Ether. So do those whales affect the price? That was the core of our research and what I'm going to present to you now. Let's dive deeper. Okay. How do people typically analyze the relationship between activity and prices? How do people address this question? Because it's the number one question that's asked whenever there's a major price movement, like what we're experiencing now with this bull market. Typically, people look to these 4 buckets of types of analysis. There's sentiment. You can scrape Twitter, or you can wait for Elon Musk to just tweet Ethereum with no context whatsoever, and then try and interpret what that means and trade on that. People look to order books. They'll analyze the order books. How many buy and sell orders are there? What's happening with the market? What is the depth of these order books? And which exchanges should we be paying attention to? They'll look to on-chain events. I don't know if you follow the whale alert. Every time there's a major movement on the blockchain, there's a tweet, and then people do actually potentially trade on that signal. And then people also look to technical analysis. So can I trade on the market fundamentals that people have been working to build out? But what we're doing on this research is we're focusing on a new type of indicator, and that's on-chain flows. On-chain flows is activity that's registered on the blockchain, and that's different than what type of activity is happening on the order books. So we did statistical analysis of these on-chain flows specifically from the whales that we identified to exchanges to try and see what is the impact of these flows to those exchanges. And this chart shows the net flows of whales from the whales that I showed you earlier on to exchanges. And what you can see is when there's a bar going up, that means that in that month, whales were net receivers of Ether, and then the following month, for example, in May, they were net senders. And it's interesting because for a lot of the time in 2016, the sending activity actually netted out the receiving activity. But then you do have these rather large spikes occasionally in activity. The question then is, what is the impact of these large sell-offs from whales to exchanges? And a lot of times what we've experimented with is, can we just look at correlations between this activity? How correlated are flows with price changes? Or can we make a scatter plot or some sort of time series that just plots out the events and then try and make a good judgment based on just basically looking at the data? The problem with that is it's kind of a statistical problem, and that is that do the whale movements to and from exchanges drive price, or is it the reverse? Do price drive the whale movements? And so teasing out that causality is what we were really interested in, because it's a signal that we have and that we need to analyze that. So what we did was we used this model called vector autoregression to estimate the causal effect on Ether price of these 3 indicators: Bitcoin price, whales sending to exchanges, and whales receiving from exchanges. And I will now talk about the results. So what did we find? Well, we found that when we're just looking at the testing variable of price, the price level of Ether, we found that Bitcoin price is the only thing that had a statistically significant impact on the Ether price. So our variables, whales sending to exchanges and whales receiving from exchanges, didn't actually have a statistically significant impact on the price level. So maybe that's a problem with the model, but also maybe that's just because it's not there. That's not, the signal from the flows isn't impacting the price level. But we wanted to dig a little bit more. We thought there has to be something in these flows. This is a new variable. There has to be some signal here that we can use to build future models. And we actually were successful in finding some results. And those results were that when rather than looking at the price level, we looked at volatility, intraday volatility. Intraday volatility is just defined as the difference between how high and low the price gets within a single day. And we found that whales sending large amounts to exchanges does have a statistically significant impact on the intraday volatility, not only of the exchange, which is the recipient of those funds, but also across the entire market. But Bitcoin price and whale receiving from exchanges didn't come up as statistically significant in this model. There's a lot of caveats to this research that I will speak to now. The first is that identifying whales is really hard. And it's only through years and years of spending a lot of time trying to identify which are the services and which are the whales that we're able to actually have a somewhat clean data set to be able to successfully do this. And so without knowing exactly which are the services, that would really disrupt the signal that we did actually find. The second caveat is probably the most important one. It should have been number 1, but there's a varying lag between whale movements to and from an exchange and an order being placed. And what that means is the data that we have at Chainlaysis is, like I said, on-chain flows. So we can see when someone wants to send a large amount of Ether to an exchange, but what we can't see is what trade they're then going to execute on that exchange. So if I send like 100,000 Ether to an exchange, that doesn't mean that the next day or the next hour I'm going to put in one sell order of 100,000 Ether. I could just be topping up my wallet. I could be deciding that I want to use a custodial service on an exchange. And so that makes it really, really hard to consistently try and see what the signal is, considering that every single whale probably has a different idea of what they're going to do once they send those funds to an exchange. Number 3, different exchanges have different prices. So a whale's choice of exchange might be relevant. Some exchanges can handle massive amounts of liquidity, and others, our smaller exchanges, can't. So the same amount of funds being sent to a certain exchange might have a differential impact than on the same amount going to a smaller exchange. And that really speaks to and is tied into point number 4. We looked at a general impact of whale flows on the market. But it's hard because each there's a lot of different variables that matter. For example, there's a lot of anomalous sell-offs that spike the activity and then have a differential impact on the market than maybe some of the majority smaller sell-offs. And so by looking at this general impact of flows on price, it might not be useful if you see a large sell-off and then try and figure out what the impact of that large sell-off might be. That being said, it's still important to analyze the flows because this is a new signal, this is a new indicator that it's information. And so the more information the better when you're building a trading portfolio. And finally, number 5, the 5th caveat is that our data, there were some problems with the model. This is a very, very trend-based ecosystem. And so it's really hard to totally extract the underlying trends when you're trying to do statistical analysis. And so our model did suffer from autocorrelation, which means that the current values are correlated with their past values. And so that just means that we need to continue to improve these models. But, and we're working on a few different types of models to try and tease out that causality. So I'm going to conclude with just kind of summarizing some of the takeaways, and then maybe we can have 1 or 2 minutes for questions. So first, whale flows don't appear to affect the price of Ether. What we think, though, does impact the price of Ether are things like sentiment and the price of Bitcoin, which we did find in our regression. But whales sending to exchanges may increase intraday volatility. This is particularly interesting because it parallels a lot of the academic literature that you see in the stock market. A lot of stock market academic papers find that when you're trying to figure out what's causing certain stocks to be extremely volatile, they found that it's large flows or large anomalous activity that impacts flows that's impacting volatility and not the price level of those stocks. So it's kind of reassuring to see that this ecosystem is kind of behaving in a way that makes sense or parallels what's happening in the stock market. Okay, the third point here is that there are these are general trends and not analysis of one-off major price fluctuations. So I would be reluctant to give you guys the numbers of how much whales impact volatility and then have you go apply that number to a large sell-off and expect that exact number to be the amount of change in volatility that is experienced, because this is just a different type of analysis, but still the event level impact. So if I were to ask for what is the exact impact of one sell-off of 100,000 Ether on an exchange, you would need to run a different model for that, because this is generally over the entire period that we analyzed, this is the total overall impact of whales on price and volatility. And then finally, this is like a life lesson that we learned. This analysis requires extremely careful data preparation and model design, and it's ongoing. One of the things, this research is hopefully going to be in an academic paper, and so we're really hoping that people will kind of fight back and do another paper telling us how we were wrong, because there needs to be a lot of improvement in how these models are used to tease out what this signal is in flows. But once we get there, it will probably be a great indicator upon which people can trade on. I have 40 seconds for questions. Does anyone have any? Yes? The secondary effects, like people watching the whales and then yeah. No, that's a really great, he's asking, could it be a self-fulfilling prophecy that people are observing these market movements and then that observation is impacting the price? And it certainly could be a factor. You know, even when people are watching whale movements from what we know to not be a whale, but they think is a whale, that is creating this kind of level of this new signal in the market that is almost creating a whale even though it's not really one. So it's an interesting point. Yeah. Okay. Oh, yeah.
I was wondering about the definition of a whale. Do you apply clustering techniques, so where you allocate multiple accounts to one entity, or do you say one whale is one address?
Oh, we have a lot of different heuristics that we use to identify whales and services, and it's not as straightforward as just looking at one entity and saying that that's a whale. We apply a lot more complicated analysis to it. I'm happy to talk to you after. Yeah. Okay. Thank you.